as the athleisure trend and outdoor activity boom continues. Sales were actually 45% higher than in the same quarter of 2019. Just unbelievable. A different story for Nordstrom, though, which is sinking despite a beat and raise quarter as sales remain below 2019 levels. So, Nancy, Nordstrom or Dick's, do you stick with the winner or pick up Nordstrom as the value play here?
Well, as a shopper, I say Nordstrom, but as an investor, I think Nordstrom is a very difficult stock to own. There's leadership issues. If you look at their sales, they have not returned to pre-pandemic levels, and the margins are not expanding as fast as even Macy's. If you go into the stores, you'll see that there's very little selection, and they've cut back staff pretty dramatically, and you kind of go to Nordstrom to get the experience. I think Dick's has demonstrated much better leadership, much better management, and they're moving towards the experiential shopping experience, and I think that's not the case at Nordstrom. And so I think you want to stay with the winner here and wait for Nordstrom to get it figured out. Because last thing I'll say is they don't even get credit for the rack, which is also still below pre-pandemic levels, but it's never really shown up in the valuation. And I think maybe they need to rethink the strategy.
Steve, would you echo that? Is there anywhere else in retail? I mean, it is surprising to see that Macy's can execute better than Nordstrom in an environment like this.
Yeah. So I agree with everything that was just said. But I'm going to go a little bit underneath the hood, and we'll talk technicals. Yeah, JWN Nordstrom ran 20% into the print, Kelly. What does that tell a trader? Is that maybe it was already baked in? Maybe that's the reason for a little bit of the weakness coming out of the print. I do believe that Dick's, on the other hand, pulled a lot of sales forward. Sporting goods, bikes, fitness equipment, glamping, as probably all of us would do versus camping, right? So when I look at it, I say, at first blush, I'd like Dick's better, but I don't think it's ever been this far extended above its 50-day moving average. It's about 30% above its 50-day moving average. I would wait there. I would actually buy Nordstrom.
Wow.
But I don't like any of the fundamentals involved in Nordstrom. The only reason why I would buy it is technically it's finding support around that December 2020 level, and maybe you're due for a bounce.
All right, so a difference of opinion here. Mike, full disclosure, I just bought my parents a glamping trip, and happy birthday, Dad, today. I'm not asking you to sort of make a call here, Mike, but what would you say when you look at the technicals versus the fundamentals and the fact that we have two big moves in these stocks this week?
I think what's instructive, Kelly, is the divergent responses showed you the level of uncertainty that investors have about just exactly what was mostly a pandemic phenomenon and what's the norm afterward. Because Dick's is getting credit for, okay, maybe this actually is a more enduring kind of lifestyle shift, younger people, that's going to be more of a spending pool that gets more money over time. Whether it is or not, that's the market's conclusion right now. Whereas, Nordstrom, after Macy's and Dillard's had much better beats, I think the question is, okay, I guess we're back to where we were before, which is department stores are kind of sluggish and challenged, and maybe they look cheap, but probably for a reason.
Right, or worst case, they're the odd man out. Fair enough.
Yeah.
All right, moving along. Oh, by the way, be sure to catch Nordstrom CEO Eric Nordstrom on Closing Bell at 3 p.m. Eastern time. So, of course, a lot of questions to ask him executionally about the brand in this environment. Next, the battle for vaccine supremacy. Pfizer shares are actually lower today despite getting full FDA approval for its COVID shot this week. They also just started rolling submissions for FDA approval of its booster dose. And J&J is also losing steam after saying its COVID-19 booster does prompt a rapid and robust immune response in test patients. Both stocks higher on the year, Steve, but Pfizer versus J&J, someone else in the space, or would you avoid the vaccine names altogether?
So I am long Pfizer. It's been a perennial holding of mine forever. And so I would have to go with that one. Full disclosure, I am long it, as I said. It's up 30% year-to-date against Johnson & Johnson, which is up 10% year-to-date. Kelly, what we always say as traders, you get good news, bad price action, maybe it's already in the stock. That's probably what we're seeing just a little bit here. But I would say that nobody has any clue as to how many boosters you're going to need, how ongoing this is going to be, and how much corporate America is going to demand that you get these shots. Ultimately, they're both buys, but I would stay with Pfizer.
Nancy?
Yeah, I'm going to disagree with Steve again. I think from here you want to own J&J, and that is just because of the robust biotech pipeline they have from their acquisition of Actelion, and the fact that they have a lot of levers to pull and they've underperformed on a valuation basis. It's more attractive in our work, and I think eventually the vaccine boost to the stock prices will fade, and we'll be judging these companies on fundamentals again.
Well, we have like the whole market summarized here with Nancy and Steve on this panel. So you for J&J, and I appreciate it. Let's talk about the consumer clash of names looking to go public. Eyewear maker Warby Parker is planning to go public via direct listing on the NYSE. Its S1 showing sales grew in each of the past 3 years, but its losses did too. It's expanded, remember, from online only to 145 brick and mortar stores could be part of the cost. Also on the docket is Dutch Brothers Coffee filing to go public and expecting about a $100 million capital raise on a $3 billion valuation. They've grown from a single pushcart in Oregon to the largest privately held coffee chain in the U.S. with more than 400 stores. Mike, start us off here on, I don't know which of these two is the more interesting IPO story to you.
Well, Warby Parker certainly, I think, is the one that's more eye-catching. I honestly didn't plan to use that pun, but I just thought of it right now, simply because the brand has been so buzzy for so long. But looking at the numbers, they operated near break-even. It's not necessarily the kind of thing where it's so early in its development phase that you can have these huge pie-in-the-sky expectations for just how fast it can grow. I don't think, because, you know, it's a defined market. It's not like people are going to buy 5 times as, as many pair of eyeglasses next year as this year. So it's about market share game. It's consumer habits. It's an interesting brand, but not necessarily killing it on the bottom line. Dutch Brothers, coincidentally, last week encountered them for the first time when I was in the Pacific Northwest. Kind of a fun theme. My daughters knew about it from social media, stuff, I guess, and they wanted to try it. So I think that's a more familiar story of a well-loved regional chain that actually has lots of expansion possibilities in other parts of the country. Don't know necessarily it's going to be some kind of big profit bonanza either, but it seems like it's a more clear path to how they grow from here.
Well, now we're homing in on where you were on vacation last week, Mike. So Dutch Brothers is going to help. And I've learned over time with these rapid fires, investors want to follow what the Santoli girls are doing. That has been a profitable strategy. Nancy and Steve, I want to say
it was a moderate thumbs up on the coffee. Look, let's be honest. They serve mostly desserts in a 20-ounce cup. It's like
exactly.
Sweet stuff.
I don't like Starbucks coffee. It clearly hasn't hurt their growth prospects. Nancy and Steve, just a quick word. I want to save time for the banks. Nancy, would you buy either of these IPOs?
I mean, I'd take a look at Warby Parker. I do think they have an opportunity to grow revenues in more of like a service model. And by that, I mean, contacts are just 2% of revenue. And if you get the return visit of contact purchasers, that could be a great revenue source. So I think if I had to pick, and I don't like Dutch Brothers Coffee either.
Steve?
So I agree on the 2% area of growth in the contact lens. But even management's not sure that they can have any consistent earnings going forward. So we're going to keep the show consistent. I'm going to go with Dutch Bros on this one. And I think they have drive-thrus, and that's what this segment is actually reaching for. They already have them.
More research for me to do. Finally, the battle of the banks. New data from B of A shows financials have overtaken tech as the sector with the most share buybacks. After a record-setting week of them, by the way, 4 of the 6 big U.S. banks announced billions of dollars in new buybacks last quarter. The 2 largest were a $25 billion commitment from B of A and $30 billion for J.P. Morgan. So, Nancy, as buybacks become a part of what would make these stocks potentially attractive, unless people want that capital used in other ways, B of A or JPM, which one's more attractive to you?
On our work, it's JPM, Kelly. And I think we've been making an argument that the buybacks across all sectors have been putting a floor under the market. And that seems to be the case. We're above pre-pandemic levels. But we also like the dividend increases. So our commitments are JP Morgan, Goldman, Morgan Stanley. B of A is just too expensive on our work. I think it's a great company. So I go with JPM.
Steve?
Here we go. And I agree 100%. And when you look at the year-to-date performance, B of A is up 39%. Against, I think, middle 20s in J.P. Morgan. So they've definitely outperformed, and that would get to the point where they're a little bit more expensive. J.P. Morgan is definitely best in breed. You could ask 10 people, and I bet you knee-jerk reaction is 80, 90% say that J.P. Morgan would be their bank of choice. And to that last comment on buybacks, you can't reach across the market, right? You can't, because there's a lot of rules to buy back in your stock. You can't shop the order. So you can't run the stock up on a buyback, but it's extremely supportive when people know that the buyback is there.